What's going on, everybody? We have 90 of you watching live on our webinar platform, various people around the web. Before we get started and let Wayne give his business updates on the topic at hand, which is everything co-working or flex space, for anybody that is paying attention and focused as the number continues to climb, you can see the comment section. There's a place where you can post comments or questions within the device that you're watching this from. And so if there's questions that you want answered, this is your place to do so. You can do it for your peers, or you can do it to hear directly from the CEO as a part of this process. So Wayne, thanks again for doing this. We've had a tremendous time learning your story. And again, for anybody that's watching now, you can watch some of our previous episodes where we've talked with various partners and professionals within the organization. But Wayne, give an intro to you, give us kind of an update on state of business as a kickoff to our discussion today.
Yeah, thank you, Nick. Great to be back on with you. Great to be on with all of our partners today and prospective investors. Thanks so much for taking the time to join. We know that time is valuable, so I very much appreciate it on behalf of the organization, IWG, International Workplace Group. Quick background for those of you who we have not had a chance to meet. My name is Wayne Berger. I'm the CEO of the Americas here at provider of flexible workspace and co-working solutions, 4,000 locations here across the globe, spanning 125 countries, over 1,200 cities. Most specifically, as we're welcoming potential partners here and partners across North America. If you take a look at our North American business, we are now roughly about 1,600 locations, both opened and signed under construction, due to be open over the next 12 months, and across about 525 cities here in the US and in Canada. So operated for close to 30 years, and it's been an extraordinary growth period over those 3 decades. And I think really from what I'm seeing, the most electric, the most exciting time is ahead of us. As I try to do, Nick, on this call, I could spend days discussing, our value proposition and how we've been going to market. But what I'd like to do, I think of most value for everybody listening and watching on, is maybe just give a bit of a state of the market. What's happening within the commercial real estate industry? What's happening with companies and with workers? What are the latest trends? So these are the latest trends right up to actually yesterday. So this is very, 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 very relevant and very timely. So where do we sit in the market? As I think everybody knows on this call, we've really entered into unprecedented times in the commercial real estate industry. I frankly think we're in the single biggest structural fundamental shift that we've seen in the office space, commercial real estate industry over the last 100 years. It's really remarkable. And that's due to how people are really shifting. When I say people, representative workers and companies, leaders and workers, how people are choosing to work moving forward and really defining how, what, where, why, and what we call work every day. So if you look at the numbers, office vacancy has continued to climb, ongoing throughout 2023. We're now at record vacancy rates. In the US, we are just under 17% vacancy rate or availability rate across the US. The number in Canada, for those Canadian partners listening in today, is surpassed 18%. Those are up from record lows that we achieved back in 2019. So it's been extraordinarily dynamic in terms of the shift. This year alone, in 2023, tenants have collectively given back to the market 47 million square feet of space since the beginning of this year. Total occupancy is now at record lows. But what's really interesting with that is office using employment is 12% higher than we've ever seen. So although we're at record vacancy rates, office using employment is actually at record highs. And the quantity of space that's formally occupied, but frankly is like nevertheless for lease, is 50 million square feet above its historical norm, having risen steadily since mid 2020. So what does that tell us? Well, number one, today's occupiers, give you an idea in aggregate, the demand for space is about 440 million square feet less than where our employment levels suggest. So that's really telling us two things. One, it could be telling us that the occupied square footage per employed worker is literally coming down at a dramatic rate. It's 8% below what it was entering 2020, accelerating this decade-long trend of shrinking space per worker requirements. But I actually think it's something different than that. It's not just about occupied square feet per worker. What we're also seeing is companies very much rationalize their real estate portfolio for the reasons we've discussed in the past. Companies are becoming more geographically disparate than ever before. Their teams are not just located in one physical location any longer. They're working in a more flexible way. Companies are attracting and retaining employees beyond just the borders of where they used to be located. They're hiring people within the city, outside of the city, outside of the state, outside of the neighborhoods, sometimes outside of countries. We're becoming more geographically disparate than ever before, and they're doing that to attract and retain great talent. We're also seeing that leasing activity is dropping considerably. New leasing activity is down 15% versus pre-pandemic norms, and the average size of a new lease has shrunk by 20%. So companies are moving more so towards flexibility for the talent elements, and then also for the financial implication, right? We're seeing companies rationalize their traditional conventional lease portfolio, where they're taking some, and in some cases, all of their traditional real estate portfolio that used to be under conventional lease, that obviously is costly. That's a multi-million-dollar investment of capital required to underwrite a lease, to manage a lease, and then also just to build and furnish and manage space. They're taking those funds and either moving all or some of those funds, supporting this new flexible way of working, which is what their team members, what their clients, and what their employees are demanding. And they're using that in other areas of their business, whether it's further research and development, investing more in people, or new products, new solutions, new markets. So this trend of stagnant demand is anticipated to continue to linger, and more companies are moving towards space as a service, and they're frankly using office space much more dynamically, literally for some just via access via an app, and giving their team members access to space regardless of where they want to be. Because one of the biggest trends we are seeing is that also just people want to eliminate a costly, unnecessary commute. So if you look across the top 30 markets in the United States, every one of those markets, with the exception of one, and love to hear what people think that one market is. I'll share it with you in a couple of minutes, but there's one market out of the top 30 markets in the US that are showing any type of positive net absorption. All 29 of 30 markets, top 30 markets in the US, are all showing negative absorption. The absorption rates are going backwards. They're seeing more space come online. There's only one market in the US that has shown positive net absorption, and that market is Miami. It's the only market. So it's one outlier market out of the top 30 markets. And in Miami, we saw a net absorption rate of about 900,000 square feet. But what's interesting about Miami is vacancy rates are 12%. They're not 6, they're 12%, they're double digits. Right now, across the United States, there's 1.4 billion square feet of available commercial office real estate in place today. So it presents a time and an opportunity to do something very different.
Wayne, appreciate that opening. I'm going to bring Mike into our screen. Mike, thanks for joining us. What I'm going to do to lead into the first opening for you, Mike, is Wayne, I want you to answer this because I think this is critical, especially to everybody that's watching. And again, anybody that's watching, if you have questions for Wayne or Mike, please enter them into the chat and we'll make sure we get to those questions as we continue on. But Wayne, the reality is IWG Regis has been around for a long time. The business was already the thought leader in the space. It almost seems like it took some time for maybe environments to happen in 2020, but also for you to have a clear positioning back to a landlord or business operator, business building operator on what the value proposition was of being a partner with IWG. Do you feel that was part of some of the magic that has happened over the last few years, that you perfected what is your why you why now as it relates to the problem that you can solve for a landlord or a building owner?
I think we had to learn it first, Nick. So what's interesting is, having been around for 34 years, founded by Mark Dixon, who still is our global CEO, highly involved in the business. We practice a very similar business model up until the pandemic, which was invest at times billions of dollars a year in capital to grow our network. Right? We had a network that was 3,000 locations strong, primarily associated with a capital lease, invested by both the building owner and IWG to build, manage, maintain the facility, et cetera. And we did that for 30 years. Primarily, we've always had partnerships. We've had a robust franchise partnership business for the last 10 years, very, very healthy, very, very strong. We've had hundreds of building owners who've been strategic partners for decades. But a significant amount of our business was highly capitalized for a reason, which was it offered great return on net capital. If you look at our business, like our business today, and for years has been very cash strong, very, very profitable. We demonstrate return on the net investment within a short period of time. And we grew because of that return on net capital, right? So it just made sense. What we discovered towards the late 2010s, that second half of that decade, and what's really come into play now is, first we discovered the fact that, look, the demand continued to outstrip supply. We're 4,000 locations strong, by far the largest provider of flexible workspace in the industry. And this industry still only represents 3% of what many experts predict will be 30% of commercial real estate within the next 7 years, right? So even through investment of $1 billion a year in capital to add more locations, to invest in them just to meet the ongoing growth and demand of our client base, we still couldn't keep up. We recognized that we needed to pivot. And part of this was really looking to move to become the platform that clients were looking for. Picture Airbnb, Marriott Bonvoy, and Booking.com all wrapped up in an app that's as simple to maneuver as your Spotify app. That's really what it was coming down to. We saw the future in clients and companies wanting to access office space as simply as going online and seeing what was closest to them, right? And to do that, it requires a network that frankly is bigger than 3,000 locations. And we also recognize that to invest, that requires invested capital in technology and infrastructure, in partnerships, and recognizing that the business has strong returns. We can turn to partners like Mike and other partners around the globe and frankly help them solve a problem, which is this growing vacancy rates, help provide a solution that helps them monetize their space, help them really appreciate the benefits that we've been appreciating for the last years, driving great NOIs in their building, driving great return on net capital, and then in turn, grow the network to meet the burgeoning demand that we see and make it really simple for clients, right? It's really trying to connect the dots with the future. And well, I say the future, but really today, right? What we see today ongoing is we have 1.1 million companies and people that reach out to us every year looking for space. It just continues to grow, especially with what's taking place in the current economic condition and how companies are becoming more untethered than ever before. This gave us an opportunity to say, look, let's partner with strategic partners and let's help them solve a problem while we can meet the demands we're seeing.
Appreciate that. Mike, I want to shift over to you. So there's a twofold question. One, welcome. Two, would love for you to give a little bit of background on your story. And then how did you catch the IWG wave? Like, how did this get in front of you and how did you move forward with the business?
Well, thanks for having me. We're a family office, been in business for over 100 years. We own a variety of properties. We're involved in most sectors of real estate. We have 3 office buildings in town, and office is a tale of 2 cities now. You either have a Class A office in a suburban, well-located market, or perhaps downtown, but mainly suburban is kind of where the action's at from our standpoint. And it's either 100% leased or with record rents or near 100%, or it's really struggling. And fortunately, our buildings are pretty well located. We did 3 deals with Regis, IGW. We didn't intend to necessarily, but it just it started with a building that is well located on a freeway in North Scottsdale, and we were approached by Weston Reed, who's he's out looking for buildings, and as we started talking about that building, we had a vacancy in our Scottsdale building, and he had been trying to find the owner of a building out in Goodyear in the West Valley of Phoenix that's brand new. We're the only one to ever build spec office in that market out there. It's a market where 95% of the workers commute from there to downtown Phoenix or Tempe, and the drive it's the worst commute in Maricopa County. And so co-working is just it's a new avenue. I would like to say that we sought them out, but it's not like we talked to all the players in the market. We went and toured a couple of the facilities. We love the spaces model. We like the model in general, but we like the build out, particularly in spaces, which, as you guys know, is a higher end version of the traditional Regis or the HQ model. Mm-hmm. And we just think it makes sense. There's a ton of people that they don't really want to drive an hour. They don't even want to drive a half hour. They got used to working in their pajamas out of their kitchen for a couple of years, and now they're done with those sorts of commutes. So none of our locations are open yet. We're still space planning and bidding out the TIs on all of them, but we expect them to be very successful.
So, Mike, on your process, and I want to back into your process. You're looking at your buildings. You see vacancy. You see a problem. Do you go down the journey of saying, could we do this on our own as a family office, or was it immediate? We want to look at finding the right partner for this.
No, we would never consider doing something like this on our own. We do manage our own properties, but co-working space is a whole different level of property management. We have enough employees. We don't want to have 1.2 FTE managing, office workers that could be coming. They may not even be your own client, right? They may be coming from LA and they happen to be in Phoenix and want to use an office for a week. And plus we don't have the the marketing platform that you guys have, obviously. So, I mean, at the moment we get the site plan done and the build out's confirmed, it goes in the marketing system for IWG, and they start marketing it. And the goal is to be 40% occupied by the time our TIs are done. So none of that is of interest to us. As Wayne was saying, buildings, the average tenant size is smaller than it was a year ago, and certainly probably even 10 or 20 years ago. When we built the building I'm sitting in, it's 256,000 square feet. It's at the gateway to Paradise Valley, Arizona. It's on Lincoln and Scottsdale Road. It's a timeless building. It's 100% leased. We just wouldn't want to have to deal with microscopic tenants. We went from, when we built it in 96 and 98, we probably had 30 tenants, maybe less, maybe mid 20s. And now we have over 55 tenants. So, the Bank of Americas and the Morgan Stanleys and the Smith Barneys, who's gone, they're not leasing as much space. And it's much more of a entrepreneurial sort of use now than it is big corporate. So, and what IWG allows is for tenants to get to 100 square feet or 10 square feet in a co-working space in a lobby. So we don't want to operate that ourselves. We want somebody that has the system in place to manage it like a health club would. It's very similar to a health club membership, we think.
Mike, looking at your background on the financial side, it seems like you would be the toughest critic of building a partnership. So the fact that they could get through you means you had to check things off and checks and balances and making sure this is the right partnership. Did you have any hesitation or any roadblocks that you had to overcome in your sales process?
Yeah, we're taking all the risk here. So it's not for the faint of heart. I'm not pounding my fist on telling everybody to do this. I think a lot of everyone's talking about it right now, and everyone's talking about the fact that it's not a lease anymore, right? It's a management agreement with an entity that has no capital. Every deal that is set up, it's a single purpose entity. We're taking all the risk. We're spending the money on the TI. We do have some outs in the contract, but it's a 10-year deal. And, but we think the market needs it in every one of our buildings. We think it's something that makes a lot of sense. And, it's a revenue share, right? So if it works, we're going to be generating 140% of our normal rents. So if it doesn't work, is the space usable? Yeah, it's usable space. And, we see the downside as being fairly limited, and we think we're with the company that will market it right, and we'll all win together.
Wayne, when you hear Mike go through his process of overcoming hurdles to eventually say yes, where does your gut go? And do you see this as a common thing that anybody that's been in the sales process does have to overcome, and you're seeing them overcome it based on the deal count that you guys are doing?
Yeah. Well, I think the first thing that comes to my mind transparently is we owe it to Mike to make sure that we knock it out of the park, right? It's just number one, right? What I'm really excited about personally, having been in this organization for 10 years, is one, I care a lot about enabling our clients to be able to live a better life by having access to great workspace, right? Absolutely, that's the case. And for the exact reason that Mike mentioned, this opportunity now to create this new hub for people that don't want to travel that worst commute you can possibly have in Arizona. I think that's absolutely the case. It makes me think about another location we just recently opened up in a small town called Truro, Nova Scotia, a town that very few people have heard of, 14,000 people. But when you looked at that town, the residents of that town drove 65 miles each way to go to work every day. prior to the pandemic without a thought. Now they have an opportunity to be able to be enabled to live and work much closer to home. And it's been very successful. The need's been there. So my first immediate thought is we will, not only do we need to, but we will make sure that those locations are extraordinarily successful. Right? That piece is critical. Secondly, what we've been building out is exactly that. We want to make sure that the services, the demand engine, the optimization of space in terms of resources, tools, and people are all in place to help support our partners like Mike. Right. So yes, there's a process to go through as a partner makes a decision, and from there, there's a process to launching. And the first thing we want to do is make sure that the mics within our organization are surrounded by a team of experts at IWG to help design, build, construct, and launch that center incredibly well. Right? This is a good example where, from a launch perspective, we take ownership. Right? We want to, because it's what we've done for 30 years, 4,000 times over. Right? We've learned through all the challenges, and we've optimized the processes to make sure that we launch incredibly well. And then the goal is to drive success and revenue, and ultimately net proceeds through as the center matures. So all those pieces are really critical. And the last piece I'll make mention, and I'm glad, Mike, you shared your thoughts around the process. The one thing we would always encourage any potential partners thinking about this is ask every question. Be pragmatic, be thoughtful, be discerning. It's an investment, right? And we are making an investment as well. You know, when we launch a center, there's a significant amount of financial and people resources that go into marketing, driving the sales, supporting the center through launch. We want to make sure that every location that is opened up is the experience that our 8 million clients expect, right? There's a ubiquity to Regis and Spaces and HQ, whether it's somebody who lives in Dubai and is traveling to Arizona for a meeting, or it's somebody that used to travel to the Scottsdale Spaces location and now has 3 new great opportunities that may make more sense for them. Right? There's an expectation they have, not just of design, but what the service is going to be. So it's very critical for us that we make sure that both IWG resources and then the resources put forward by our partners, that we're driving great return, right? And that the expectation of the client is met. And I'll add one last piece, which I think is really fascinating. Up until a couple of years ago, when we thought about clients, it was usually our end user client because the market was growing so quickly. If you think about where we're moving, though, in North America, we now, in a short period of time, have 425 partners like Mike in a very, very short period of time. By this time next year, you know, the balance of our network in North America will be partners like Mike. You know, we have 1,000, let's call it corporate locations, for lack of a better term. But the reality is, by this time next year, there'll be more than 1,000 that are partners, right? So ensuring that we support every partner, not just through the signature, but launching a great location and frankly, driving the return on capital, the 140% of the gross market rent that Mike had mentioned, that's critical, right? And we can demonstrate that through the 30 years that we've operated in Arizona as a good example, right? So we want to make sure that our partners are incredibly successful.
Mike, I want to ask you a question, and then I'm actually going to turn it over to our audience because it's more so everybody that's watching this. This is your show, so I'll facilitate the questions. We'll go through all of them. But Mike, I heard scale off the start. You said three locations is what you signed up for. That seems rare, especially for a financial guy, to say we're going to scale at that pace. What was the mindset of saying let's do 3 versus 1, and how is that mindset going today?
Well, we had space available in all 3 locations, and they were, you know, one's a lobby space in one of our 3 buildings here. One is shelf space in a spec building that I think is is probably the highest demand market, the one I mentioned in Goodyear.
Mm.
And the other, we had a vacancy on our major tenant moved to a Scottsdale building. So, it was kind of more opportunistic than anything. And so, we just think, as I mentioned before, that there's high demand for co-working space. And, if we're actually having IWG manage the build out of those, we're paying them a fee for that. It made sense to us to do that. We're not a general contractor, and we're not even really a developer. We're more of an investor. So we're having the conversations. We negotiated the agreement. We're building out the space. We think the product makes a ton of sense in today's environment. We wanted to be kind of more first to market in this new model, and so we've got a 50-year time horizon, and we're pretty well capitalized. So we don't really usually take a lot of risk, but on our own assets, we're willing to invest for the long term. So it all just made sense to us.
Out of curiosity, if this first run goes well, is there still scaling opportunities within your portfolio? Is there still test ground here on the first three?
No, I would say this is, this is the work we're going to do. I don't see us. We don't have other office. We're focused more on industrial and multifamily than we are office per se. I think you want to be careful as an investor how much concentration you have in your building in co-working space. We think 20% or less is probably the right number. Otherwise, you might have investors or lenders getting a little confused or concerned about not having a lease commitment, on your rent roll. So we're, we're doing 3 deals, but it all represents less than 20% of the space in those buildings. So, and I think there was an interesting article that CoStar did on WeWork versus other co-working space. And IWG's strategy is much more suburban, whereas WeWork and probably less than 20% in most buildings, although I think IWG would like as much space as they can get in the right locations. But people, the whole reason they're going to co-working space is to stay closer to home. So to have very large co-working space in downtown suburban markets was really the wrong strategy. And I think what IWG is, it makes a lot more sense. And so again, it comes down to, we think it makes sense to do it. Do we want to do it ourselves? Absolutely not. So it was fortuitous that they came to us, but in doing some research and talking to the brokerage and investment community, we think what we're doing in these 3 buildings, that we don't really intend to sell them anyway, but we think it would only enhance the rent roll, and I think it'll make all 3 of the properties more valuable long term.
Okay. So what I'm going to do on the questions, we have a ton in here. I'm just going to start working down from the top and see just how far we go, and I'm not going to filter them. I'll put some commentary on them where I see opportunity. I'll guide the 2 of you to probably the answer. So David said, can you give an overview of the Ohio Cleveland market? Wayne, I assume that's a specific question for a rep, and that ultimately he should connect with a rep versus just general thoughts. But any comments there?
I just think quickly, because I know there's a lot of questions, I want to make sure that partners can connect with Mike on it. David, I'm more than happy. We can connect. I can provide, and our team can provide as much information as you need on the Ohio Cleveland market for sure. It's a very good market. We've actually been growing in the market, especially on the West End. Back to Mike said it a few times around the suburbs, and there's been some really strong growth within that West suburban market. So let's connect offline. We're happy to share some more details with you.
Okay. Seth said, what is IWG's average occupancy?
Well, it's tough because it's basically all over the place, right? So, well, it's actually not all over the place. What we normally find is, it's interesting. once you hit 85%, you actually, from a co-working flexible workspace perspective, it starts to become more interesting trying to fit the puzzle pieces together, because at 85 to 90%, very rarely do you have 3 or 4 contiguous offices together. They're kind of individual offices spread out. If you look across the markets, on average, we're definitely kind of starting to push towards those types of areas, which is great to see. And some markets are obviously performing better than others. So it's tough to give just an exact occupancy, but we're certainly pushing back upwards towards those high levels. And we've been recovering since the pandemic each and every month. We have some markets that are, I think, very, very strong, where we just demand continues to outpace supply. Markets like Florida, Nevada, Texas, Arizona, really, really strong markets overall that we just continue to see more demand. But occupancy is really starting to push beyond some of those higher levels that I've mentioned.
Mike, for you on either of these two questions, when you're looking at what's the overview of the market or what is occupancy, are these questions that you had to go through in your sales process of figuring out if this was right?
Absolutely. Yeah, there's a pro forma that gets done on each property, and it's compared to your current advertised rent, whether it's a full service rent or triple net rent. And I mean, they're able to answer most of your questions. If they don't have an answer, they'll elevate it to the point where they'll get an answer. And so the pro formas seem believable. So, but yeah, it's there. We have a model for each building, and we hope to exceed it.
And to Mike's point, Nick, the pro forma is obviously based on that specific building, but also takes into consideration the neighboring locations. So it looks at our own data, but because the last thing we want is to provide something that's inaccurate, right? This goal, to Mike's point, is the goal is a 10-year commitment and beyond. Because if you take a look across, the locations that we've operated for 30 years, many of them we've operated for 30 years, primarily because they become the work residence of many of our clients. Right. So we use our neighboring center data, cohort center data. And if it's a new market, like for example, we entered into Maine for the first time, which has been very exciting. We'll use like market data to provide as close a pro forma as possible. We want something that a partner can really invest in and take a look at.
Brad, it says, do the landlords ever realize any profits or just get the rent?
Yeah, right. It's about profit realization. Like, one, we want to celebrate when they're receiving net proceeds equal to the rent. But frankly, ultimately, the goal is to help them drive a net proceed or a profit higher than the rent, because there is an invested capital on the front end. We understand that. And we've grown our business over 30 years through those profits that supersede the rent, right? So now it's really giving partners the opportunity to take advantage of that. When you look at the construct of our management agreement model, we collect a management fee. That's it. Right? We collect a management fee. We recoup the center operating costs, like staffing, which is usually one of the largest costs relative to center operating costs. But beyond that, all the net proceeds go to the partner. And the goal ultimately is to make sure that they're realizing a higher return above what the market rent is. And by the way, trying to predict what market rent is tough for sure, unless markets are pivoting. But we absolutely want partners to realize a profit above the rent.
I want to post this on here because I'll add a comment then, Wayne, anything you want to say. But Brad also said that we're only inviting on partners who are new to these calls, not someone that's been with the business for a while. And part of that is this is a newer program. But if you do go on YouTube and you search for IWG webinar, you can find some of the older, mature partners who we've brought on to these conversations as well. But Wayne, any comment there?
Yes, it's a conspiracy theory. I'm just kidding. No, I mean, look. Frankly, it's a great takeaway. We want to maximize people's time and investment, right? So we understand it's a time commitment. It's a time commitment of Mike. It's a time commitment for all partners. I promise it may be an innocent miss. We send the invitation out to all of our prospective partners, because prospective partners traditionally ask, hey, I'd like to speak to somebody who's done it, which is why we have people like Mike on the call. They can hear me talk all day, but the reality is, or they can hear the director, et cetera. I manage our business, right? Versus, beyond just partnership, but it's a really great point, and one taken. We will ensure that all of our current partners are invited to these calls. And the other piece we're working on is, obviously, we always want to keep, I think we do a good job of this, but we want to keep the lines of communication open with all partners. I mean, today, at minimum, we hold a call weekly or bi-weekly with every partner just through their process. So hopefully we want to make sure we're always front and center to meet their needs. So we will ensure that every current partner is invited to this call, certainly.
Well, and I wanted to put this up here just to say, like, this
It's
is full transparency. This is how it goes. So
great.
Mike, I'm going to let you take the swing on this one first, because I think you're going through it. David said the process to open start is too long for my building. Is there a way to expedite this? Is that a hurdle that you had to come over? Are you overcoming it now? What's the process been like for you?
Well, we were doing three at once, so maybe it felt like it was faster. It took a while, but I mean, I don't know. The team was pretty diligent. We had the calls we needed to have, and now we have weekly calls or semi-monthly calls. I forget the frequency because we have 3 projects going on at once. But we're in the final design CD, bidding out the CD stage right now. I don't know. These things take time. Regular lease, LOI to lease, and then getting the CDs done for 10,000 square foot tenant. I mean, it feels about other than the agreement was brand new to us, and getting through that, and then also discussing the management services agreement for the build out. There were 2 separate agreements because we're having them supervise the construction of the space. That part was probably longer than LOI and lease, but it doesn't seem like it's taken that long. The management agreement's brand new to people, so it's definitely going to take longer to get it done.
Wayne, anything that you would add for speeding up the process?
I really appreciate David's comment. And look, we're trying to do 3 things. Our goal ultimately is to move from a point of contact to reaching out to the Mikes of the world to getting a center open within 16 weeks. That would be absolutely ideal. Now, there's a few things we're doing to help alleviate the process and just get things moving. To Mike's point, it is relatively new for a lot of people. So it's new. It's new for them. Sometimes it's new for the legal counsel, and shifting the mindset from a traditional lease process, which can be 150 pages, to an 18-page management agreement takes time. And this is a document that we worked in collaboration with hundreds of partners to make sure that their needs are met, and then IWG's needs are met. We want something that's a true strategic partnership. Now, a couple of things that we're absolutely trying to accelerate. One is just very specifically is the floor plan process. What we found is getting finalization on the floor plan has taken time. So what we're looking to try to do is reach consensus with our partners and then with our team that let's set a date where the meeting doesn't need to be weekly or once every 2 weeks. Let's set a date that within 2 weeks of introduction, signing the agreement, moving forward on the kickoff call, let's get a floor plan signed off. Because the floor plan is one of the major enablers to getting the center open, because without a floor plan, you can't get CDs. Without CDs, you can't get permits. Without permits, you can't start building. So we've instituted a process where we work with our partners, say, look, let's find a way to work backwards and put all our resources together, time, people, et cetera, to get a floor plan signed off from day 1 to day 14. That will help dramatically, because sometimes, because people are busy, floor plans could take upwards of 2 weeks if the update calls every week or 2 months or longer, if the update call is only weekly or bi-weekly. So there's that. The other big piece we're doing is part of this, sometimes we're at the mercy of vendors. So a good example is just IT. To get the circuits and the routers, et cetera, that are required to enable the center for Wi-Fi or connectivity, that can take sometimes months, or like our digital locking system. Sometimes we're at the mercy of vendors. We're working with our vendors to both in-source more product here locally in the US and Canada to make sure it's readily available. And two, we have temporary circuits now that we're launching in locations just to help launch sometimes within 30 days, right? So if there's a space that's fully built that actually may have been a previous co-working location, now the landlord has that space back, we can get up and running within 30 days with a temporary circuit. So part of it's supply chain, part of it's the floor plan. Those two pieces will help knock literally months off the schedule.
Mike, this is for you. What outs did Globe Corp add?
Say that one more time.
What outs did Globe Corp
Or what
add?
outs? We have an out if the TIs come in higher than expected by some percentage in excess of what the original projection was in the pro forma. And then we also have an out if we don't hit the pro forma net revenue to us within a certain period of time. We can cancel the agreement rather than letting it go on for being stuck for 10 years.
Okay. Justin asks, on average from opening, how many months does it take until occupancy reaches the desired 75 plus levels? Wayne, I assume this is it's market specific, but
it's market specific. But if I can give an overarching commentary, to hit 75, 80%, I would normally say like conservatively 20 to 24 months, right? So within that second year, we should start to hit that level. We try to aim for anywhere from 10 to 20% at soft opening to get things moving. We take a look at the market. Some markets open stronger than others just based on demand, pace of demand, and based on supply. And then from there, we usually like to see full maturity, at a conservative state at the end of that year too. And we normally see we like to normally see return for our partner. I mean, as early as possible, certainly, but at that year 3 to year 4 mark. So at that point, everything else is just pure proceed.
Okay. Kenneth says, with a conventional lease, there are financial guarantees. Are there guarantees with an IWG deal?
So I'll hit on this one because Mike brought up the point around the single asset entity. What's interesting is within our current business, conventional lease, all of our locations are single asset entities, regardless. It's not whether it's a partner location or a conventional location. And by the way, that's very, very common across a number of industries, from hotel to restaurant to fitness. Most subscription-based businesses, single asset entity is a very commonly used legal entity. But by the way, most building owners and developers use single asset entities across each one of their assets. Many of our building owners use a single asset entity under their partnership agreement, and then have an entity that carries a leasehold from a financial and a legal perspective. So it's a very commonly used element. But what's interesting in this case is, I appreciate the question. It's like, are there other guarantees to an IWG deal? Like for us, this comes down to performance, right? For sure. And there, in this case, we're making the financial investment and as well the ongoing commercial investment to make sure that the location launches and drives the returns that we collectively anticipate based on the pro forma. That's the goal. So the invested capital into the location is on behalf of the partner, right? So for the most part, if you take a look, the approach from a guarantee perspective is actually consistent, whether it's a conventional lease or not.
Okay. Trying to be respectful of time, we'll just try to cruise through as many of these as we can. Yeah, great questions. Carrie said, how are appraisers valuing these spaces under a management agreement versus a traditional lease? Mike, any comments there?
We haven't got to that, but we did discuss it quite a bit with the industry, investment sale brokers, and these agreements are new. A lot of the deals in the market are still leases, but they're getting converted to management agreements when they renew. And the bottom line is there was a building here in the Camelback corridor, for those of you that know Phoenix, that traded with a co-working deal. It wasn't IWG, that had only been in place for less than a year or maybe a year and a half, and it traded for a fine number. And the buyers are just looking at the trends, So if you've got a brand new deal, they're gonna try to trend the rents. If you got an old deal, they're gonna trend the rents and look at how sticky, has the revenue been fluctuating a lot, or has it been a steady revenue stream? I don't think it bothers investors that, as long as it's not 80% of the building. Again, if it's less than 20% of the building and it's generating net revenue at 140% of what a typical full service deal lease would operate, to me it's a diversifier, if anything else. You're not going to have 400 tenants leave at once at the end of the 10-year term on the agreement, right? I mean, these people that are all going to the co-working space are going to generally go there, and they may vary day to day, the humans that are walking into the space, but does it really matter? I mean, the revenue stream is the revenue stream. So I think an appraiser is going to look at the historical income and probably trend it without a vacancy factor, so, but I don't know. We have loans on all three of the buildings. We ran the agreement by all three of our lenders, and all three of them thought it was a great idea. They think it's a diversifier. So,
okay. Keep running. Daniel says, what metrics does IWG use as size and office in a particular market, Wayne?
Simple measurement, we usually apply about 38 square feet per, let's call it workstation or desk. And one of the things that have driven the success in our model is we normally look to drive about 65% density on the floor, which basically means taking 65% of that floor and using it as what we call residential revenue, which is office space that people go to, which makes up 72% of the total revenue, which is pretty best in class in the industry overall. Our competitors normally drive about 6% of revenue outside of residence. We're roughly around 28 to 35, depending on the market. So,
okay. Mike, being respectful of time, if you have to bounce, no problem. Wayne, if you're good sticking around, we have a few more questions. Just keep cranking.
I got about 5 minutes.
Okay, great. Next question from Taron. Can you sublease the property and set up an IWG center? What is the investment cost to set up a co-working center? Whom to contact for it?
So first off, let's do this. Tarun, send me an email directly. I'll put you in contact with the right person, just based on where you're situated and where the building's situated. Secondly, yes, you can sublease the property. It does require you to work with the building owner to ensure that both the building owner and the current lease tenant would support the sublease, right? So that is one piece that you want to be able to work on prior. Not normally an issue, just is a requirement, but you can sublease a property and set up as an IWG center. We've accomplished this a number of times around the globe, as well as certainly here in the US and in Canada. Investment cost to set up a co-working center, it all depends, especially on the sublease piece, on what the current build out is. And it all depends on how much you want to monetize in the returns. It could be as little as what we call setting up the starter kit, which is anywhere from $70,000 to $100,000 based on the size of the center. And that is really the mandatory elements and investments that are required to make sure that a client who walks in has the same services they would expect at any location. So cloud-based printing, coffee and tea services, all those elements, some signage, all those elements. It could be as little as that. We have some partners investing $2 to $4 million upwards, sometimes higher from shell. I find I remember when Mike and the team were working on the agreement with Globe, and I was really appreciative of the approach they took, because the 3 locations all have different types of investment portfolios. One shell, another one's a takeover or a conversion of space. So yes, you can sublease. It can be as low as that. Send me an email. We'll get you in contact with the right people.
Okay. Justin says, is there an average benchmark occupancy percentage rate to cover the operational costs?
Yes, it's usually anywhere from about 35 to 47%.
Okay. Amanda says, how willing is IWG to negotiate the terms of the standard management agreement?
Simple answer is not, right? But I'll be less succinct on that. Look, it depends on the element. We negotiate these agreements every single day. I mean, the call I was on right prior to this is with our legal counsel to take a look across each agreement and understand what's important to the partner and then what we can negotiate on. What we've tried to do, in all sincerity, is come up with an agreement that makes sense for partners and covers the commercial and legal elements for both partners and IWG. It started, give you an idea, like I mentioned earlier, we've gone from 150-page leases to a management agreement that used to be about 90 pages, that went to 78 pages, that we dropped down as far as 28 pages, now is 18 pages. Something that is commercial for the partner, something that lays out the terms and conditions, and then something that meets both legal requirements so we can move forward in a very efficient way. And also, frankly, just manage the costs that get exorbitant at times in trying to finalize a lease. This is not a lease. This is a managed client agreement. It's a partnership agreement. So it's a different construct. Do we try to minimize the negotiation? Because frankly, there's not much to negotiate in the agreement.
Okay. Jason says, how does IWG locate or choose an office for a client in regards to co-working spaces that are located in neighboring buildings owned by separate landlords? Market saturation is the concern.
I love the question. Number one, market saturation is not our concern. And I mean this, like, our goal is to ensure that every location is incredibly successful. If you look at the future trends that analysts are predicting, flexible workspace will represent 30% of commercial real estate in 7 years. Today, even within the 1,600 locations that we have in North America, it's 3%. To get to 10%, we could grow to 10,000 locations across 110 million square feet and only be at 10%. So the market demand still outstrips supply. We are in the bottom of the first inning with where this industry is going. Now, absolutely, we look at market saturation and we look at market penetration at the very localized market level. So we have demand principles, we have demand numbers that we can look back on, whether it's a month or years, to see what is the incoming demand. That helps us identify where just pure demand lies. We look at population trends within the very specific market. And then we also look at other demographic, firmographic numbers. We look at affluence scores. We look at overall where white collar office workers live, not just work. Those help us come up with demand principles that help, with varying degrees of confidence, determine where we feel a co-working location can work. And then stripping all that away, when we look at, I'll talk about Arizona, for example, or Nevada, when you have a state that is 90% plus occupied, we just still can't keep up with the demand. So just rudimentarily, there's opportunity for further growth. But those are some of the demand principles we look at.
Love it.
Wayne, I actually have a question.
Please, Mike. I know.
Yeah.
Mike, I'm interested. Where else can we improve, Mike? Is that
I got this question. This is not a room for improvement, but it's if anyone can use our space, any one of your clients,
Yes.
but their revenue is going to a different property.
Yes.
How do we benefit from? What if everyone comes to our building, but they're actually clients of a different center?
So it's a great question. So can I hit that question on both? Mike, number one, because and I apologize, I should have answered this a little bit earlier because I think it was being asked indirectly. Number one, our field organization, the sales organization, both globally, IWG Direct, our local salespeople, our center teams, they're all compensated in a very agnostic way. Their goal is to find the right location for the client. There's no understanding within the organization, and there's no compensation driver that would have them choose location A versus location B. It's all about finding the right location. So, for example, a partner location versus a corporate location, that doesn't matter at all. What they are commissioned and paid to support the location that makes most sense for the client. That's the key piece that I want everybody to know. For us, it's agnostic. Frankly, again, by this time next year, this is going to be a partner-driven organization. We want partners to succeed while we continue to see great return on net capital. So that piece really critical. It's fully agnostic. Secondly, to your point, Mike, our clients, if they reside in Goodyear, one of the benefits of joining IWG is they can go to any location globally, right? Now, what's interesting is the average number of locations that people use are like 2.1. So it's a benefit that is exceptional, but it's still like reasonable rarity because people really connect to their residents, whether it's their home or their work. So there's not as significant as it's called an exchange of revenues that go from center to center. It's more so like a benefit that's there when needed. But really about 99% of the revenues are normally captured within the home location.
And if the client moved from Scottsdale to Goodyear, you would probably, if they kept going to that location, you would move them, I'm assuming.
They have the ability to transfer or port their location. Yes, absolutely. It's one of the benefits that we offer that is unique to the industry, where if somebody wants to move or if their company shifts, they can move, whether it's down the street or out of the country, they can port their remaining contract into another location. So it can work either way for sure. And for us, again, it's totally agnostic, right? We just want to make sure the partner's in the right place.
Thank you. With that, I'm going to sign off.
Mike.
Nick, Wayne.
Mike,
thanks, guys.
And thanks for your investment. And thanks for your confidence.
Yeah, wonderful conversation, Mike. Thanks for the contributions, Wayne, as always, very lively. Audience stayed totally dialed in throughout. Reach out to anybody on this webinar on LinkedIn or find us online. For Mike and Wayne, I'm Nick. This is another episode of Meet IWG, another great lively discussion. Thanks, guys.
Thank you.